Okay, welcome everyone. So in this session, we are going to look specifically at Learning Unit 6, our capital allowances. So I'm going to recap a few things which we just need to look at, and then we are going to work through some practical questions to apply the theory on a more practical note. So like I've always said, in each and every type of question, what you need to do is please show me your calculations. The reason for that is if there's anything that you've miscalculated or you've missed the step, I can still provide you with some effort marks, which would, in the end of the day, help you get the 50% that you guys are working towards. Okay, so let's quickly look at what are the learning unit objectives specifically for this learning unit. So the first thing you need to be able to do is to find the different terms used in the income tax calculation. So that is our income tax framework. You need to know where all of this is basically falling into our definition. Then you have to distinguish between repairs and improvements. Now, the one you would be allowed to take off as a deduction when you do your taxable income calculation, whereas improvements would be seen as capital in nature, and that would form part of your base cost, which we will look in the next session when we discuss your taxable capital gain items. Then you have to be able to calculate your capital allowances. Now you'll see the three section numbers that they specifically refer to is section 12C. Now that talks about assets specifically used in manufacture. Now, if it's a new and unused item that we are using in the manufacturing process, so that means we are basically creating a new product from scratch, then we would get a capital allowance of 40% in year 1 and then 20, 20, 20 in years 2 to 4. Whereas if it's a second-hand item we're using in the manufacturing process, it would be 20% for 5 years. Then section 12E is specifically relating to your small business corporation. So in your question, they need to state that you are a small business corporation before this will be applicable. Now, what makes this section a lot more enticing for small businesses is the fact that if they create manufacturing items or they work in the manufacturing space, their assets will be 100% deductible in the first year they bring it in, as opposed to the 40% in terms of section 12C. And then all the other assets would be 50% in year 1, 30% in year 2, and 20% in year 3. Now, when we look at a practical example today, we will just show you that again. And then section 11E is all your other wear and tear allowances for your non-manufacturing assets. Now, that is based on the useful lives that SARS has depicted for a specific asset. Now, you do not need to know the useful lives list in your tax workbook. That will be provided in the question. They will tell you what is the period. Now, if it's a small business corporation, you can look at whether the 50, 30, 20% would be more advantageous versus the number of years in terms of section 11E, and then the business can decide which one they would prefer. So normally they would try and write it off sooner rather than later. So if the 50% would be better for them in the short term, they would rather go for the 50, 30, 20%. Then we have our capital allowances specifically looking at your business or buildings. Now, January is 5% for your buildings in your manufacturing process after 1 April 2007. And then depending on whether you have purchased or erected a building or office building, you would have to apply the 55% if you've created a new building, or the 30% if you've bought it secondhand. And then they've got additional items for your low cost residential units, and the percentage is applicable to that, and we're quickly going to go through that as well. And then similar to what we've done with our normal deductions, or where you have your wear and tear allowances, we need to look out for any recoupment when we sell any of these assets, or the scrapping loss, that's where we're selling it at a loss, then we can get an additional deduction in terms of Section 11O. Now, if we look at a tax framework, we are currently under the line item less capital allowances. That is what we are going to focus on today. So if we look at capital allowances, it is broken down in Section 11, which is your wear and tear allowances, Section 12, as well as Section 13. Now, normally you would start off with your general deduction formula, and that would exclude any items which are of a capital nature. Now, that is why SARS then brought in these specific section numbers to allow you a deduction for the use of these capital assets in your business. Now, it's generally written off. We write off the cost over the asset periods or the useful life of the asset. Now, remember, if you are a VAT vendor, you would have to remove the VAT component out of that asset. If I buy an asset second-hand, there is a deemed input VAT or notional input VAT amount included in that value, which we would have to remove before working out our capital allowance. Now, your cost includes any moving costs or installation or erection costs that you have to spend money on in order to bring that asset to your business or the location where you'll be using it for. So that additional cost you would add on before you work out the portion that is written off for the year. What is, however, excluded is the VAT, because it can normally be claimed, and then any finance charges. Now, the reason they exclude finance charges is because we do not want to give someone that has to take out a loan to buy an asset a better advantage from a tax point of view than someone buying it cash. So for that reason, finance charges are specifically excluded. And if an amount cannot be quantified, then you have to wait until you can quantify it before you actually take the deduction. Now, repairs and improvements, just to touch on that again, repairs is when we spend money on some type of property or machinery or implements, but we're bringing it back to its original condition. We are not improving it. We're not making it better than it was previously. We are just servicing that type of machine back to the condition where it was when we acquired it firstly. Whereas improvements, which is also seen as capital nature and not deductible, is when we make it better than what it was initially. So either we create a new asset or we improve our current asset rather than restoring or replacing specific parts of it. Now, for Section 12C, you need to know these percentages. You need to be able to distinguish whether it's a new and unused item or if it is a used item. The reason for that is there's two percentages, but this relates only to machinery or any plants that is used in the process of manufacture. Okay, and that also includes your moving costs. Now, as you can see on your screen, when we do the write-off, if it's new and unused, it is 40% in year 1, and then year 2 to 4 is 20%. If the asset does not qualify as plant or machinery, so it's any other type of asset, or it is a used asset, then we will write it off over the 5-year period at 20%. So that is important to remember that when you look at a question. Now, who can tell me, what does the process of manufacture mean? Based on what I've said so far, what would you say is the process of manufacture? You just type your answer in the chat function. So if I ask you, what does the process of manufacture mean? How would you explain it to me?
Ma'am, I would say using raw materials to create a product.
Okay. I also see creation of a product has come through. So yes, when we talk about process of manufacture, let's for example say we take a rod of steel and then it goes through a machine, and after it's gone through the process, so after it's been heated and put through a forming machine, then nuts and bolts come out at the other side. That is a process of manufacturing. That is where we take one type of product, so it's generally raw materials, or it can be a product that has already been formed, for example, but now we have to assemble it together to, to create something new. So you're basically creating a new item either by using raw products or using products and assembling them together to create something else. So you can also, for example, get like the wheels, the wipers, windscreen, and then when we combine all of it together, we create a car. Similar thing. So we are basically creating a new product that we will sell. That is the process of manufacture. So it's any plant or any machinery that is used in that process would be applicable to this section. Okay, when we talk about wear and tear we calculate over the expected lifetime. Now, when you get the tables in a test or if they write it in a paragraph, it would normally indicate the number of years that asset will be used by a specific type of company. Now, how we work out the wear and tear is you take the cost or the cash value excluding any VAT component, and we then divide it over the number of years we expect to use that asset to work out the wear and tear for that year. Now, what is very important to know is you have to apportion it for Section 11E specifically if we use it for a period less than 12 months. Whereas Section 12C, you do not apportion at all. You get the full 40% or full 20% for the year, irrespective of the fact that you might have only used it for 2 months. Whereas with this specific section, you need to apportion it. So if I use the asset only, for example, for 2 months, I would take, let's say the value of the asset was 100,000. It was over 5 years expected lifetime. So we take the 500,000, divide by 5, which gives us 20,000 for the year. Now let's say we only used it for 6 months. That would mean we would only deduct 10,000 in terms of this section. What is also important to note, if the amount is less than 7,000, you are allowed to write off the full asset value, that amount, within the same year that you've acquired it. You do not have to write it off over the number of expected lifetime. Okay, so that is something important to note in case they ask it. In terms of Section 12E, this is now specifically for small business corporations. If they tell you in the question, you're not a small business corporation, you ignore this section. Then you move to Section 12C. If they tell you you are a small business corporation, you apply this rather than 12C. Okay, so this is specifically for your small business corporations. What it does is it gives them a quicker write-off of the assets to reduce the income in the first number of years to try and build their business. So as I said, if we have a manufacturing asset that is new and unused, 100% of that asset is written off in the year that we brought it into use. We do not need to apportion it, same as Section 12C. For all your other non-manufacturing assets or used assets, you would apply the 50, 30, 20%. You can still claim the Section 11E allowance for your non-manufacturing assets if you can get it at a shorter period. So let's say, for example, it was computer equipment, so which sometimes you can write off in 2 years because of the fact that they age so quickly, then I would rather go for the 2 years write-off, which will be quicker than the 50, 30, 20%. So you have to look at the information in the question to determine which one would be more advantageous. If we look at the building allowances, so remember for a building allowance, generally it's 5%. It excludes the cost of the land. We do not write off land at all. Now this is specifically for a building that is used in the process of manufacture, for example, your factory building, and the allowance also excludes any leasehold improvements amount will be excluded from your building allowance deduction. Then if we've got commercial buildings, it's generally 5% annual allowance at the lesser of your cost or market value for any new or unused buildings. So that's applicable from 1 April 2007. If it's prior to that date, there was no write-off at all. Now, similarly, if you acquired a new building, so you created a new building, 55% of the price will be used. So that means you take the purchase value multiplied with 55%, and then you only apply the 5%. Whereas if it's a second-hand building, I will apply 30% instead of the 55%. So in the question we're going to look at today, we are going to look at this concept so that you can see how you need to apply this information. Okay, and this is only applicable in commercial buildings. The reason they brought in these percentages is because of how the industry have grown. A lot of the prices are inflated, and SARS have decided to reduce the amounts to make it a more reasonable deduction for business purposes. Now, if we have residential units, you have to look at whether it's low-cost housing or just a normal residential unit. Now, how do I know if it's low cost? The first thing you have to look at is what is the cost of that unit, whether it's a standalone or apartment. If it's a standalone unit and it's less than 300,000, or it's an apartment that is less than 350,000, it is considered to be a low-cost residential unit. Another thing you also have to look at is that the monthly rental charge is less than 1% of the cost. Now, the cost is that 300,000 or that 350,000. So that means you need to ultimately earn rent for less than 3,000 or 3,500 rand. If it is low-cost residential unit, you write it off at 10% per annum over 10 years. Whereas if it does not fall into that low-cost residential unit classification, we write it off over 20 years at 5%. And then that 55% and the 30% also applies to the initial cost of those residential units. Urban developments, that is where we are either refurbishing some of the buildings in our inner cities or we're constructing new buildings. If we refurbish our old building in our inner cities, you can write it off over 5 years at 20%, whereas if we demolished it and we built a new one, it would be 20% for the first year and then 8% for the remaining 10 years. And similar to all the other assets or the buildings, you apply the 55% if you purchase a new building, or if it's a second-hand one, 30%. And any improvements to existing buildings, so to any other type of buildings, it will also be 20% over 5 years. If it is improvements to a low-cost residential, we write it off over 4 years. Okay, so this is the losses on disposal. So this is the additional scrapping allowance. This is generally where we dispose of an asset at a loss. So the proceeds we receive, so the value we sold it for, is less than the tax base or the carrying value at that date. Then SARS allows us to deduct the difference between what the tax base, the carrying amount is, and the proceeds we receive for that year in addition to that. Okay, and this is just to show you how to do the calculation when you do your calculations in your test. Okay, so what we're going to do now is we're going to work through question 6.2, 6.4, And if there's time left over, I'm going to look at question 6.3 as well. Okay, so what we're going to do is I'm going to share now the PDF file, and then we'll work through it, add comments to it, and then do the physical calculation. If there's anything that you are wondering about, please stop me or ask me so that I can re-explain it to make sure that you guys do understand these capital allowances. Because if you actually do understand this and how to do the calculation, you can make sure you actually pass your test or your exam at the end of the year. Okay, so I'm just going to stop sharing this, and then I'm going to share the PDF file with you guys. Okay, can you guys see the PDF on your screens? Can you guys see the PDF before I continue? Okay, so similar to your test, similar to your exam, the first thing you do when you get a question is you scroll down right to the end to see what do you have to do, what is required from you. Okay, so in this question, they ask you to calculate the tax liability. Now remember, when we talk tax liability, that means we are looking at the taxable income multiplied with the applicable tax rate. Okay, now depending on what type of company we have, it will either be 28% or it might be a sliding scale if it's a small business corporation. Then we tell you that it's at 30th of September 2021. So that means if we look at the tax period, it would be from 1 October 2020 up to 30 September 2021. Okay, so that is my tax period that I'm working with. Now, why do I need to know this? If they include any prepaid expenses as well in the question, you would have to also take that into consideration. But because these questions now focus more on your capital allowances, I don't expect to see any prepayments in this question, but that is why you need to know what your tax period is in an exam for in the event they give you other information. What they also tell you is when amount or transaction does not affect your calculation. So that means if it is a zero. So it has a zero value. You have to give a reason why. Now the reason can be it is not allowed, it is capital nature, for example, if it's a general deduction, or it is prohibited in terms of Section 23, or it does not meet the requirements of a specific section to be deducted. And then also very important is show your calculations. It is important to show your calculations. If you make a mistake, we can still apply method marks in your test, in your exam. So even if you get the value incorrectly and it counts, for example, 2 or 3 marks, I can still give you a portion of the marks if you've indicated your calculations. Okay, now let's go read through the information. What have they provided to us? So they tell us ABC Electronics manufactures smartphones and tablets. And this is a process of manufacture as defined. So here they're telling you it is a process of manufacture. Now what you have to go look out for is what section are we going to apply? Is it going to be section 12C or is it going to be section 12E? Now 12E is specifically for SPCs, where 12C is for any other type of business. So let's see if they specifically mention if this is an SPC. They tell you the company is registered for VAT, as a registered VAT vendor, which means we need to remove, VAT from the assets value before doing our capital allowances. Okay, so this is what they are specifically telling you in here, the fact that we are a VAT vendor, and they tell you all the amounts exclude VAT unless otherwise indicated. Okay, so we are registered for VAT. Okay, let's quickly just see if they mention at the bottom if it's a SPC. I don't see anything, so that means we will be applying Section 12C. Okay, so for the year of assessment, what information did we have to see? So we had sales for the value of 4 million. Okay, so that would go to our gross income amount. So this we will capture under gross income. Then we've got purchases. Now remember, for the purchases, we have the amount that we physically spend during the year. Now, because this is inclusive of VAT, we will have to remove the VAT amount for our deduction. Okay, so our deduction is exclusive of VAT. Then we've got raw materials. Now remember, raw materials in this case is our inventory. So we look at the opening costs or the opening balance and the closing balance. So for opening balance, we add that, or actually we deduct that from our income. So this is part of a deduction, whereas our closing balances, we would add it back in our calculation. Okay, so that is important to note. What amount you will deduct, which one will you add back? Then we've got, we donated tablets to a local charity with a cost price of 12,000, a market value of 25, and we received the Section 18A certificate. Okay, now based on this information, at what value will we recoup the tablets that we've donated? Who can tell me at what value will the recoupment be? Okay, so you guys say it's cost. Now, why do you say it's at cost? What was the reason for it? Okay, so it's the lower value, but the reason for it specifically is because we've got a Section 18A certificate. That means we've got a donation to a registered PBO. So because it's to a registered PBO, we take the lower of the cost in the market value. So in this event, it is the cost. If it was not to a PBO, then we would take generally the market value amount, which would normally be higher than our cost price. Okay, so the donation to a registered PBO, and that is limited, the deduction will be limited to 10% of the subtotal exactly before we work out our taxable income. So when you see Section 18A certificate, you also need to remember that there is additional deduction we can deduct later on. Then if we continue, we can see salaries and wages was 700,000. We purchased a factory that is new and unused, okay, for 900,000 in 2018, and the land portion was 200,000. Okay, now let's quickly look at our years of assessment. So year one would have been 2018, year two, or actually it would have been 2019 because our year end was September. And let's quickly see. Factory, new and unused, 20 for 900,000. Okay, let's first start here. We have to take that 900,000. So the portion we're going to deduct or work out our capital allowance will be the 900,000 excluding the 200,000, so the land component. So that means we will only do a capital allowance on the value of 700,000. Okay. Now, because it's for a factory and the factory would be for the manufacturing process, we would apply section 12C to that. Now, in year 1 would be 2018, would be 40%. Year 2 would be 2019, which would be 20%. Year 3 would be 2020, which would also be 20%. And year 4 would be 2021, which would also be 20%. Okay, so that is just what the years would look like based on the fact that we are using this in the process of manufacture. But we will only apply it to the 700,000 because you have to exclude the land portion. Then we've got our office space that is rented, and we tell you the rental expense is 6,270 per month, okay? And we've used it since 1 February 2021. Now, if we count from February, so we've got February, March, April, May, June, July, August, September. That is 8 months, which we will apply this to. I'm just going to write you 8 months. So when we do the expense, we've got 8 months. Okay. Then we've got our machinery. Okay, sorry, this is not 12C there. This would be section 13. Section 13, because that's only the factory, and that would be our 5%. And then we would have to apply the apportionment based on the fact that it's a new purchased amount. Okay, so let's quickly look at machinery here. We purchased our machinery new and unused on 1 March 2019. We paid 1,368,000 for the machine, and we sold it on 30 June 2021 for that value. Okay, so what you see here is we have sold it for more than its original cost. So 1, we will have a recoupment for the portion that we've already deducted, and 2, we would have a capital gain which we need to take into consideration. Now, in today's question, I'm also going to show you how to do the capital gain, even though we haven't done the learning unit yet, just so that you know what is happening. Okay, so in this event, because we bought it in 2019, our year 1 would be 2019, which would be 40%. We would have year 2, which would be 2020, which would be 20%. And we would have year 3, which is 2021, which would also be 20%. Because we sold it in 2021. So when we work out the recoupment, we will recoup, in fact, these deductions or the capital allowance that we have received, because we are capped at the original cost when we work out the recoupment, and then the difference between the original cost and the sales value would then be seen as our capital gain. Then for machine B, it's a second hand from a non-vendor. The cash price is 262,200. Now what I said is second hand you've got notional input VAT, which we have to remove from that cash price when we do the calculation. So it's from the 1st of March. Now, if it's second hand, we apply the 20% over 5 years. Okay, then they tell you it was struck by lightning in August 2021. And it was scrapped to a non-vendor for 34,200. So the question is, do we have a recoupment or a loss, a scrapping allowance? Okay, so that will be dependent on what the tax value or the carrying amount at that stage would be. Now, normally, if it is struck by lightning, it would generally be more a scrapping allowance than a recoupment, but when we do the calculation, we would actually see that. Then we wrote off bad debts that was recorded in the receivable ledger at 7,980. So we can write that off, but we have to remove the VAT again when we do the deduction. And then we paid annual annuities, all VAT exempt, for 2021. So the first one was to a former employee who retired to further their studies. Now, based on the annuity deductions, what are the requirements before we can deduct an annuity? So out of the two, we've got a former employee who retired to further his studies, and we got dependents of former employee who passed away. Now, out of those two, would one, both, or neither of them be deductible in terms of the rules? What do you guys think? Okay, so let me just ask the question again. Okay, so Marentia says the second one is deductible. Now things both will be deductible. Any other takers? Okay, so the first one is not deductible. Why is it not deductible? Because he retired, he didn't retire due to ill health or old age. Okay, so only if you retire as an employee due to ill health or old age, so you're older than 55, are you allowed to get that deduction. So because he retired to further his studies, he did not meet the requirements to get a deduction. Whereas the second one is to dependents of a former employee who passed away, so this would actually be deductible in terms of the requirements. Okay, so for this one would be deductible, one would not be deductible. Okay, I'm going to share the Excel file with you guys now. So just let me know if you can't see the Excel on your screen. Okay, you should be able to see it on your screen now. Okay, so based on the information they've given us, let's now then complete this file. So the first thing they told us based on the information is we had sales to the value of 400,000, 4 million. So you include the 4 million as your income, which would generally be under gross income. Okay, so we include the sales. Then they said we have purchases to the value of 1.7 million, but that was inclusive of VAT. So what we had to do for the purchases is you would have to take that 1.7 million, you multiply with 100, divide by 115 to remove the VAT component to get to the value you are allowed to deduct for VAT purposes. So I'm just going to make it negative because you can deduct it. Okay, then we've got raw materials. So they gave you the opening balances and the closing balances in the question. So they told us the opening balance based on the stock was 300,000, which we deduct. And then our closing stock was 200,000, which we add back. Now, as you can see in this question, you need to clearly indicate what is deducted and what is added on to the question. So in this case, I showed a negative because it's in Excel, but you can do the brackets for me in a test, which also indicates it's a negative amount. Okay, then further to that, they told us in point 4 that we donated tablets to a local charity. So we said there's two components to that information. The first one is because we've donated it to a charity, it is deemed that we have recouped it at the cost because it's to a PBO. But then we also give the additional 10% deduction that is limited to the subtotal, which we do right at the end. Okay, so let's firstly show the recoupment amount. So it is donated to a PBO, so therefore it is donated at cost, which is the 12,000 Rand. Okay, so that's why the cost was applicable. Now, we park the second bit of number 4 until we get to the end of the calculation to work out how much can we deduct for the donation we have made. Then the next information they've given to us was salaries and wages, which was to the value of 700,000, which you can deduct in terms of section 11A. Then the next point is we've purchased a factory. Now we said the factory is in terms of section 13, so we take the 900,000 times 5%. Okay, let's just quickly go back to what it said. If this one is also excluding the land value. Okay, so in terms of the notes for the industrial building, we need to exclude the land amount as well. So we need to deduct the 200,000 from this item, which gives us 700,000. Just correct this here quickly. Which is the 700,000, which we apply the 5% to. Okay, so you need to deduct the cost of land from your value that you've purchased. Okay, then we've rented office space. Now we said for that office space we rented, we only rented it for 8 months. So we take the 6,270 Rand, we multiply it with 8, and that gives us 50,160. Then point 8, we purchased a machine which was new and unused, which section 12C applies to. So it's 40%, 20%, 20%, 20%. Now, what you have to do, because of the fact that we've disposed of it as well, you want to work out the carrying value of that asset up to 30 June to work out what is the tax base at that stage to work out your recoupment. So what you do for that machine is you go start off with the cost, which is the 1.368 million. Then we work out your capital allowance per year. Now we said year one was 2090, which was 40%, which is 547,200. Year two is in 2020, which is 20%. Year three is also 20%. Now, because we're in year three, that amount would be the capital allowance that we include in our taxable income amount. The other amounts would be the prior year. Then we work out what is the tax value at that stage. So the tax value at the date we dispose of it is 273,600. Now we want to work out the recoupment. So what we do is we say the recoupment is the 1.482 is limited to the original cost of 1.368. Okay, and we then apply that and deduct this 273,600 from whatever the amount is. So we take the 1.368 is what we've then seen as our proceeds. We deduct the tax value to work out our recoupment as 1,094,400. Okay, so if you want to go add it together, it is basically all the allowances we were allowed to deduct previously would be our recoupment. That is just to check that you've worked it out correctly. Then from a capital gains tax point of view, which we haven't discussed yet, but we're just including it here for completeness sake, your proceeds would now be that 1.4 million, which you sold it for, less what you've recouped already or were taxed on as a recoupment. So our new proceeds is 387,600. Our base cost was the original base cost, so the original cost less the recoupment as well, which is our tax value. And then our gain for that one specifically is 114,000, which we then include in our capital gains tax calculation. So remember, when we do capital gains tax, we add all the gains and all the capital losses to work out the aggregated capital gain or loss, and that would be taxed. The taxable portion of 80% will then be included in our tax calculation. So that's why we've got a separate column for that. Then we move on to machine B. So we said machine B was a second-hand item that was 262,200, which we purchased from a non-vendor. Now for that one, we've got notional input VAT, which we need to account for. Okay, so the first thing is we take out the input VAT for that machine to work out our cash price. So we take the 266,200, we multiply with 100 over 115 to give us a value of 228,000. And then we apply the 20% for that year. Sorry, this is 2021. So we apply the 20% because it's in that current year. We do not apportion it for this year at 45,600. Then we work out our tax value similar to what we've done for the previous one. Because of the fact that it was struck by lightning, we've now disposed of it. But for the scrapping allowance in this case, what we say is that 34,200 is limited to the original cost less the current tax value, which is that 45,600, which is more than that. So we will use the 32,400 when we work out the scrapping allowance. So we received 34,200 and we deduct the 182,400 to work out the additional deductions. So the difference between our tax value and what we received was the 34,200 we can get as an additional deduction. Now from a capital gains tax point of view, how you would apply it then, your proceeds is your 34,200 and your base cost would also be the 34,200 after taking the original cost less the allowance and the scrapping allowance amount, which gives us the 34,200, which means there was no capital gain or loss on it. Then we have the write-off of our bad debts. Okay, so the write-off of the bad debts would be at the amount excluding VAT, because we have to remove the VAT. So we take the 7,980, we multiply it with 100, divide by 115, gives us 6,939 Rand. And then for the two annuities, we said the first annuity is not deductible because they did not retire due to ill health, and the second one would be deductible because it is to a former employee that is deceased. Now, because we do not have any other capital gains, you then add up all the capital gains in that column, which means our capital gains for the year is 114,000, but only 80% of that is taxable. So we take that 114,000, multiply with the 80%, and then add the 91,200, which is our taxable capital gain portion, to work out what is our subtotal prior to working out our donation. Now remember, because we have a Section 18A certificate, we are limited to a deduction of 10% of that value. Sorry, this is 2,343, 144, which means it would have been 10% of that would be 234,000 basically. Now, because the amount was only 12,000, you can only deduct the actual amount of 12,000, and then you add that whole column together to get to your taxable income of 2.331 million. And then they said we had to work out the tax liability. So the tax liability is 28% of that value. Which gives us 652,720, and we did not have any provisional taxes paid. So that is what you had to calculate for question 6.2. Okay, do you guys have any questions on this before we take a 10-minute break? Is there anything in this question that you're wondering about or that you want me to re-explain?